Guys, good afternoon. I hope everyone had Merry Christmas, good holidays. We still have a couple of days before we can get back to normal with New Year's Eve coming up. So about one more week and we'll be out of the holidays, making things a little bit different. Looking at today's chart, I'm going to start with the daily chart. After this big sell-off that we had here, after that FOMC announcement, I drew this measured move down. So basically doubling the size of this bar. And that measured move puts us down here around 57.40 or so. And the 200 moving average is also moving up. So it's going to be around the same price, those two different targets, and they're going to be having confluence right at the same level. So over the next couple weeks, if the market starts to turn down, I'm going to be looking at that as a target and as a support level. Going into today, I had two levels that I was looking at. So the day gapped down. All right, we can see here the day gap down. It kind of gapped into this no man's land. So where was I thinking the market might go today? Two levels. One is the low of Friday, so here. So I thought the market might want to test up and test that level. Another level was the close of the big sell-off we had. And the reason it might want to come back and test that is because there were sellers of that close that ended up selling higher. And then when the market comes back down, a lot of them will end up buying back their shorts, which would create buying at that level. So those two levels, those are these red horizontal lines here that I have on the chart. So I mentioned that in the Discord this morning that those would be targets, and the market might want to get to those, and it got to both of those levels today. Both times went a little bit beyond, and then it pulled back into this range. And then went above our level here and pulled back into the range. So those are things that you can look out for. That's what markets like to test. They like to get to those levels before either continuing or reversing. There's a possible short setting up over here with the near the end of the day, the open is an important price, and possibly some bulls will be getting out and bears will sell to try to get it back to the open of the day. So perhaps we'll watch that here and see if a order sets up. So big gap down. When you have a big gap down, that increases the chance the day will be a trend day. And we can see that for more than half of today, it was in a trend. It was in a bull trend. So after this gap down, I would either be looking for the market to be having a bear trend, or if there were to be some sort of bottom pattern, some opening reversal that ends up reversing into a bull trend going up. And so that's what we got today, was a bull trend that reversed up. Looking at what that reversal was a wedge pattern. And this is something that I'm always looking at on the open. I'm trying to see a wedge pattern. So it's three pushes down, first, second, third. And then after the wedge pattern, a lot of bears that are short through here will be getting out. And they probably won't get out above this bull bar because it has such a large tail. But then this second bull bar here, probably a lot of bears will get out above that. And for that reason, it's a good place for bulls to get long. At least to go back up to the moving average, which is basically where the market tested initially. So I have that marked as a buy there. The first order we have marked is a sell below the second bar. So first bar is a strong bear bar. Second bar is an inside bar. That's also a bear bar closing near its low. To me, this looks like a good short below that, at least for a scalp. When the market has two bars like that, both of them closing, below their midpoint, the second one closing near its low, to me that looks like a good short to take, especially considering we have this target below from that FOMC day, that close. So that target is about 10 points below. A couple good bear bars, reasonable to go for a scalp to try to get down to that level. Then we have the wedge bottom, ended up moving up to the moving average. And you can see these little blue boxes I have drawn in here. These are the gaps that I was looking at. So something I'll often do is when the market is forming its bars, I'll try to find gaps. So let me move this box out of the way. So we can see we have the high of this bar here, then it broke out, and then this pullback never came back and touched the top of that wick. So there's a gap there. The price did not overlap. So I drew that box in, and you can see I have a couple more of those on the way up. Now, the reason I do that is to remind myself that those gaps are present. And when gaps are present, they're often signs of their that it's early in a trend. So when you have gaps, there's a good chance that it will lead to a trend. We have the gap here, the high of this bar, then it broke out, then it pulled back. So I initially had a box drawn in right here, but we can see on the next bar the market did pull back down below it, so I just deleted that. We have a gap here, we have another gap here, and now at this point we're above the moving average. So we're back above the moving average. Bears are not getting very good bars, and we're getting gaps. So the bulls are strong. The bulls are trapping whoever sold here or sold here. Those bears are having a hard time making money, and the bulls are kind of taking over. That's what the gaps are a sign of. So I keep these boxes drawn on there to remind me that the bulls are getting these gaps. Then now we're above the moving average and good looking bull bar. So I like marking that. Then we continue to get gaps on the way up. Another gap there. So then another gap here. I didn't draw that one in, but that's another example. So we're continuing to get these gaps on the way up, which is a sign to me that we can continue buying. So in theory, there's different things you could do. Bulls were able to pretty much buy any bear bar here and make money. So maybe some bulls were just buying closes and, just scalping. Every time you get a bear bar, they're just buying and going for a scalp. So, or maybe buying above bull bars, which is basically how we have these marked, like buying above here or buying above here, or really any of these bull bars. So as long as you're getting those gaps are staying open, it's a sign that the bulls are strong and that higher prices are likely. So buying for reasons like deep pullback, buying a deep pullback, or buying above a bull bar, those are both reasonable things to do. I have a couple more longs marked here. These longs did not work out. They're not as good. So like I have a long here and a long here. They're not as good because we can see the market is more sideways now versus this vertical, diagonal channel. The market's now moving sideways. So your odds are going to be less when the market is starting to go sideways, because now you're buying at the top of a trading range instead of buying in a bull trend. I think they're still good to have marked. I think it's still part of the theme that I'm trying to look at. I'm trying to look for, buying above good signal bars when the market is moving up. We have had this more sideways price action here, which decreases the chances, but I still like to have these marked, showing that, holding with the theme that we want to be buying above bull bars in a bull trend. Looking here, if this ends up being a good bear bar, I'm going to go ahead and get short below that. So we'll see how that sets up. Another trade I have marked here is this short here. So just like I thought it was reasonable to be buying here, once other people were buying this close or buying above these bars, and now they're feeling trapped here, and they're going to be getting out below bear bars. And so good looking bear bar now below the moving average. That's reasonable to be getting short there. So if this ends up closing at least below its midpoint, I'd be taking a short there. So it's not. That's too much of a tail. It might still be okay to go short below it. I'd rather there be more of a body there. But my idea with thinking about getting short here is that the bulls have been up for so long, and now just look at the last couple hours here. Lots of attempts to go higher that ultimately fail. And as we get into the end of the day, the bulls that are buying here are realizing their chances to make a profit at this late in the day are getting low. And we have this open of the day target that often will get filled at the end, near the end of the day. So when you start to see this kind of when you start to see the market get back below the moving average after a day has been above it most of the time, then there's a chance that it'll lead to a sell-off. So open of the day is important. Market often gets back to it, which leads to there being a good chance of there being a sell-off near the end of the day. So that's all I've got. Let me know if you guys have any questions, and just leave it in the comments, and I'll be happy to get back to it. So have a good New Year's, guys, and I'll see you next time.